It's finally here. At its Wednesday meeting, the Fed finally lowered interest rates after a long wait, which investors around the world had been anticipating for longer than Christmas. Stocks initially rose after the announcement, then fell by about 1%, and finally the S&P 500 index closed at its initial value of $6,600. But what did Fed Chairman Jerome Powell say in his speech? And why did interest rates fall now? How will this affect stocks, inflation, and the economy as a whole? Does it make sense to invest at these prices now? I'll discuss all of this in today's video, but I won't keep you waiting any longer, so sit back, relax, and let's get started. Let's jump right into Wednesday's Fed meeting. What happened there? After roughly a year-long hiatus, the US Central Bank cut interest rates by 0.25%, lowering them from 4.5% to 4.25%. Why now? The reason is the cooling labor market since the beginning of the year and the expected slower GDP growth. On the other hand, inflation in the US is still hovering around 3%, and the Fed must choose between its two mandates, maintaining price stability and a stable labor market. At this point, it has chosen to respond to the weakening labor market, which is why interest rates have been cut. The Fed assesses the impact of trade wars somewhat more mildly, and the impact on inflation may not be too great. On this topic, Powell said in his speech that it is reasonable to expect their short-term impact, but did not rule out that it could be prolonged. Our goal is to ensure that a one-off shock does not turn into a long-term problem, he added. According to him, the balance of risks has shifted, with the threat of weaker employment increasing in particular. We have taken another step toward a neutral monetary policy. We remain prepared to respond in a timely manner as the situation evolves, Powell concluded. If we look at what is expected in the future, according to the Fed's new projection, interest rates should fall twice more by the end of the year to 3.75%. This would mean that there would be a reduction at each subsequent meeting. But again, the issue of central bank independence was discussed at that meeting, because in recent months, Donald Trump has often criticized Fed Chairman Jerome Powell for his incompetence and demanded that he lower interest rates more quickly. This has not happened so far, so Trump is gradually trying to appoint his friends, such as Stephen Moran, Trump's former economic advisor, who was appointed to his position just this Monday, just before the vote. And he was the only one who voted to cut interest rates by up to 0.5%. But how did stocks, bonds, and the US dollar react? Initially, after the Fed meeting, the S&P 500 index rose by about 0.5%, which was positive, but then weakened by about 1% during Powell's speech, only to recover and close at $6,600. So this basically means that the Fed did and said what investors expected. The fear index, or volatility index, VIX, also weakened to 15.7, which is the lowest level in the last year. Gold is back at its highs, and Bitcoin also rose by 1 to 2%. Investors are not expecting anything particularly negative, and it looks like further growth in the indices is ahead of us. On Thursday, stocks will rise again, both the S&P 500 index and the NASDAQ 100 technology index. But it is precisely at times of greatest optimism that we need to be cautious. I am not saying that you should not invest today because we are at peak levels, certainly not. You just need to be cautious and not jump into everything just because it is growing at the moment. Nor am I saying that a slump, crisis, or something similar is necessarily coming. Invest wisely and don't get carried away by FOMO, fear of missing out, and the idea that everything is growing, so I'll invest in it. If we look at it from a valuation perspective, the S&P 500 index currently has a PE ratio of up to 30, which is historically very high. Sure, it is expected to fall next year thanks to corporate earnings growth, but even so, we are still at elevated levels. Historically, the index has averaged around 15, and perhaps over the last 30 years, that average has risen to 20. But even so, stocks are clearly overvalued at first glance. How am I currently behaving? I've invested in individual stocks, and even though it is difficult, it is still possible to find opportunities to invest and find quality companies at reasonable valuations. But it's definitely not the case that I'm selling stocks because they're at their highs, or because, for example, the PE ratio index valuation is up to 30, which is almost twice the historical average. So to sum up and answer the question of whether now is a good time to invest, my answer is a resounding yes. Stick to your plan. Stock markets grow over the long term, and every now and then there will be minor or major corrections, which the world will likely overcome and continue to grow. If you're investing for the long term, don't wait for major corrections. Statistically, it doesn't pay off, and we have no way of predicting the right moment to invest. Ideally, invest regularly each month using the DCA dollar cost averaging method, and you will most likely do well in the long run. Because despite all the wars, major crises, and problems, stocks and indices grow in the long term. So if you are positive about the outlook for the world, then the downturns don't matter at all. And if even bigger ones come, then it's just time to buy more, or, thanks to DCA, not worry about it and move on. But if you want to invest a larger amount today, say several $100,000 or even $1 million, then one, you don't have to invest everything in stocks, but also in other assets, bonds, and so on. And two, you can spread the investment over the next 10 months, for example, and invest one part each month, thus avoiding the risk of investing at the absolute peak. And what about you? How do you view the current situation? Post your thoughts in the comments below, and if you like the video, give it a like, subscribe, and thanks a lot, and see you later.